Okay, we are now going to start off with this another past examination question. The name of this question is Hill Company. I repeat, the name of this question is Hill Company. So let's start discussing. It says Hill Company is a public limited company which has investments in two other entities. So it's a publicly listed company which has investments in two other entities, Chandler Company and Doyle Company. So we are being told about this Hill Company that it has got investment in Chandler Company and it has got investments in Doyle Company. Now it says all three entities prepare their financial statements in accordance with IFRS, and furthermore the following exhibits available on the left hand side of the screen provide information that is relevant to the question. So there are these financial statement extracts which are available, which is extract from draft financial statements of Hill Company, Chandler Company and Doyle Company. So you could see Hill Company is in loss, the Chandler Company is okay, Doyle Company is again in profit. Acquisition of 80% of Chandler Company. Let's go through the requirements of the question, that what exactly are the requirements to this question. It says draft an explanatory note to the directors of Hill Company addressing the following. So what is it that you need to do? You need to draft an explanatory note to the following, to the directors of Hill Company addressing the following. How goodwill should have been calculated in respect of the investment in Chandler Company. Your answer should include suitable calculations and show the adjustment which need to be made to the consolidated financial statement, as well as many implications for the recoverable amount calculated at 30th September 2006. So what you need to do is that you need to calculate the goodwill and you need to tell them that how the impact, what is going to be the impact of the recoverable amount. So that is something that you need to do. So if I could just go on and okay, now so let's talk about this Hill Company. It says exhibit number 2, acquisition 80% of Chandler Company. Hill Company purchased 80% of the ordinary shares of Chandler Company on 1st October 2005. So what did Hill Company do? It purchased 80% of the ordinary shares of Chandler Company on 1st October 2005. The cash consideration of 150 million has been included when calculating the goodwill in the consolidated financial statements. The purchase agreement specified that a further cash payment of 32 million becomes payable on 1st of October 2007, but no entries have been posted on the consolidated financials in respect of this. A discount rate of 5% should be used. So this further cash payment of 32 million becomes payable is actually a deferred consideration. This further payment is actually a deferred consideration. Now it says in the goodwill calculation, the fair value of Chandler's identifiable net assets was deemed to be 170 million. Of this, 30 million related to Chandler's non-depreciable land. However, on 31st December 2005, a survey was received which revealed that the fair value of the land was only 20 million as at the acquisition date. No adjustments have been made to the goodwill calculation in respect of the results of the survey. The non-controlling interest at acquisition was measured using proportionate method of 34 million. At 30th September 6, the recoverable amount of Chandler was calculated to be 2500 million. No impairment has been calculated or accounted for in the consolidated financial statement. Now, let's have a bit of a working about this, bit of a calculation about it, that how exactly things are going to be done. So I'll be using the word processing document. Why? Because I think that this word processing document is actually going to help me Okay. For the computation of goodwill, the 32 million payable in 2 years time is a deferred consideration and should be recorded at present value. Over time, an unwinding of discount is required to be recognized on this fair value. On this deferred consideration. Furthermore, what is actually going to happen is that with respect to the change in the fair value of the land as reported by the valuer, the change shall be incorporated in the workings, as there is a 12-month time period from the date of acquisition, which is termed as measurement period change, there is a 12-month time period from the date of acquisition, which is termed as measurement period change, to incorporate the effect of the changes in the fair value identified as at the acquisition date. The goodwill is to be tested for impairment at the end of the reporting period, and any impairment loss arising shall be recognized in P&L to the extent of goodwill recognized. So what is it that you need to do? You need to recognize it in the P&L to the extent of the goodwill recognized. Now what is going to happen? Let's try to understand. Basically, I've explained that how this whole calculation needs to be done. But now I'm going to do the calculation now. So the goodwill to be calculated is as under. The goodwill which is to be calculated is as under. The cost of investment, the cash consideration that has been paid, the deferred consideration. The cash consideration that is to be paid is what? 150 million. 150 million. The deferred consideration is going to be 32 million, which is going to be payable in 2 years' time. 32 million payable in 2 years' time. Hence, this is going to be So 29.02. With respect to the non-controlling interest, and there is this fair value of net assets. The fair value of net assets is 170, and then there is this adjustment. How much is the adjustment? 10 million. The adjustment amount is 10 million. So hence resultingly what happens is okay. $160 million is going to be the net assets. The NCI is going to be 160 multiplied by 20%. Because 80% of it is acquired. Now what happens is that the goodwill is gonna be what? I repeat, the goodwill is gonna be this 51.02. Goodwill is gonna be 51.02. The goodwill is gonna be 51.02. Now what next is there? Let's discuss, let's move forward. Then what happened is there was actually an impairment calculation that needs to be done. For the impairment workings, the carrying amount of net assets at the year end are what? Let's just try to see. Okay, we might need to establish it using this financial statement. So 52 million is the profit for the year. So I'm just assuming that it is 160 plus 52. The grossed up goodwill. Because you see what happens is you have not recorded for the deferred consideration. All that I have done is I've said that this is payable after 2 years time, so that means there has to be a present value that needs to be calculated for the deferred consideration. Now the grossed up goodwill is going to be what? This goodwill is for 80% of the business. So how much is gonna be for 100% of the business? This is what the goodwill is going to be. So the total carrying amount is going to be like this. The total carrying amount is going to be like this. It is 275.78. And then what actually happens is that if this is what the total carrying amount of this is going to be, then you got to do is that you got to say that recoverable amount 250 million is the recoverable amount. So hence what actually happens is that if 250 million is the recoverable amount, the impairment loss is gonna be what? 25.78. I repeat, the impairment loss is 25.78. Now what next is going to be this? It has to be allocated to goodwill. How much? The entire 25.78. And resultingly what happens is that amount to be recognized in P&L is 80%. Why? Because this is a partial goodwill method. Why? Because this is a partial goodwill method. Now what next is there? I could just see the goodwill. In the current situation, an impairment loss of 25 million has arisen. In the current situation, an impairment loss of 25 million has arisen, which will be recognized in the of which 80% will be recognized in the P&L, of which 80% is going to be recognized in the P&L. Is that okay now? Okay, so we have done this first part. That was about how goodwill should have been calculated in respect of investment in Chandler company. Now the next situation is a calculation of the profit or loss arising from the disposal of investment in Doyle company for inclusion in the consolidated statement, financial statements for year ended so and so so and so. A calculation of profit or loss from the disposal of the investment in Doyle company for inclusion in consolidated financial statement. So now, what exactly is this disposal all about? Let's just try to see this. Exhibit number 3, disposal 20% of Doyle company. It says on 1st October 2004, Hill company purchased 60% of the ordinary shares of Doyle company. At this date, the fair value of the Doyle's identifiable net assets was this. The NCI was measured at this. The goodwill arising on acquisition was this and had not been impaired prior to disposal date. Okay. Hill disposed of on 1st April 2006. Hill disposed of a 20% holding in shares of Doyle for a cash consideration of this. At this date, net assets excluding goodwill were carried in the balance sheet at this. Now see, what is actually going to happen is that you had a 60% shareholding and now you are standing at 40%. So what are you going to do? You're going to say investment in Doyle company is 60% of the investment in Doyle company is 60%. which gives control to Hale Company. However, disposal of 20% shares will lead to loss of control, and it is assumed that significant influence shall be exercised upon Doyle Company. A gain/loss on disposal is calculated and is recognized in the P&L. Hale Company will stop consolidating Doyle Company, and any gain/loss will be recognized. The net assets, NCI, the net assets, the non-controlling interest, the goodwill are all required to be de-recognized. They're all gonna be de-recognized. Now let's just try to see this. Doyle Company, disposal proceeds less. Okay, there is this disposal proceeds. Fair value of retained interest, less goodwill, net assets, NCI. Now try to understand this. Okay, what is the disposal proceed? Let's just try to see, because you see, you had 60% shares, now you are turning into 40% shares. We are not being provided the fair value of the remaining 40%. So I'm assuming these disposal proceed to be 140, and I'm assuming this fair value of retained interest. What is the retained interest? The retained interest is what? The retained interest is 40%. So I'm assuming the value of the 40% is going to be calculated on the basis of this. This is for 20%. So the value of 40% is going to be 280. The goodwill is 50 million. The net assets right now are 590 million. The net assets right now are 590 million. The non-controlling interest is going to be what? The non-controlling interest is going to be at the acquisition date, the NCI was how much? 215 million. 215 million. And then 40% was NCI. 590 minus 510. So hence it is going to be in fact, just wait a bit. I probably have made an error in the calculation. This is so hence this is going to be what? This is the gain on disposal to be recognized. This is a gain on disposal to be recognized. So what is it? This is a gain on disposal that is to be recognized, and it has to be recognized within the P&L. The fair value of the retained interest of 40% shall be estimated on the basis of the fair value of Is that okay now? Now see, from 1st April 2006 onwards, the investment shall be accounted for using equity method of accounting. In the P&L, a share of 40% of the profits for the last 6 months, which are what? Which are going to be 123 into 6 upon 12. Are to be recognized, and the balance to be recognized in SOFP shall be 280 plus 123 into 6 upon 12 into 40% equals to how much? So gives you 304.6 million. What is it? 304.6 million. Okay. Okay, I've got a feedback from one of the student and they are saying that in the question it is mentioned that the value of the remaining interest is 300 million. Can you just guide me where is it mentioned? Yeah, can you just guide me where is it mentioned? Yeah, can anyone please guide me where is it mentioned? Because I am unable to find it. Okay. It may be a different question in the revision kit, but it's not there in this specific one. So I've just assumed the value from it because I'm not able to find it here. Okay, I'm not using the PDF version, I'm using what is available here. And here I'm not able to see any value. So I've just estimated my value. Now let's move on to the third requirement, which is how the convertible bond should be accounted for with suitable calculations in the consolidated financial statements. How the convertible bond should be accounted for in the consolidated financial statement. Okay, now let's just try to see this. With respect to the convertible bond issue, try to see this thing. Now see, it says exhibit number 4, convertible bond issue. On 1st October, Hale Company issued a convertible bond at a par value of 20 million and has recorded it as a non-current liability. The bond is redeemable for cash on 30th September 7 at par. Bondholders can instead opt for conversion in the form of fixed number of shares. Interest on bond is payable at 4% a year in arrears. The interest rate on similar debt without a conversion option is this. The discount rates are this. Now, with respect to the convertible bond, I think it's not connected to the goodwill, the group accounts. It's just the normal accounting that the examiner has discussed. So what you need to do is that you need to say that the convertible bonds are to be splitted between equity and liability. In order to split the bonds, the fair value of liability shall be calculated by discounting the future cash flows using interest rate for the straight bonds, which is 10% here. From the carrying amount of the bond, the fair value of the liability shall be deducted and the remaining carrying amount shall be recognized as equity. Subsequently, the liability shall be recorded using effective interest method. The liability shall be recorded using effective interest method. Now let's just try to do some of the calculations for the convertible bonds. First of all, what you need to do is that you need to calculate the fair value of liability. So for the fair value of liability, there is actually going to be what? You'd say here, you'd say cash flow, discount factor, and then the present value. What type of bonds are they? They are 20 million 4% bond. 20 million 4% bond. $20 million 4% bond. And then what happens is that there is this 20 million redemption. The discount rate has to be 10%. The present value has to be this into this. So ultimately what happens is, this is what we get. Now, for the initial recognition, what is going to happen is that the value of equity is going to be 20 million minus 17.92. So 2.08. So upon initial recognition, equity and liability. The equity has to be 2.08. The liability has to be this much. Now let's move a bit forward and let's discuss further. Yeah, it's good to mention the dates. Now, the effective interest workings, opening carrying amount equals to this the effective interest at the rate of 10%, the cash interest at the rate of 4%, and then there is going to be the amortization, and then there is going to be the amortized cost. So this is actually going to be this into 10%. It is going to be 20 into 4%. The amortization is going to be this minus this. The amortized cost is going to be this plus this. Okay, so what you are going to do is that you are going to say finance cost of $1.79 and is to be recognized, and the carrying amount of liability shall be 18.91. Carrying amount of the liability shall be 18.91. Now lastly, discuss the proposed accounting treatment of Hill's deferred tax asset and financial reporting issues raised by loan covenant breach. So that's the final part of the question that we need to do. Let's just talk about it now. It says Hill company has made a loss in the year ended 30th September 6 as well as in the previous two financial years. Okay. In the consolidated financial position, it has recognized a material deferred tax asset in respect of carry forward of unused tax losses. Okay. So they have had tax losses, they wish to carry forward them, and they have recognized a deferred tax asset in that respect. These losses cannot be surrendered to other group companies. So that means the other group companies are profitable, but you cannot surrender. Hill company breached a covenant attached to a bank loan which is due for repayment in 2009. Loan is presented in non-current liabilities on the balance sheet. The loan agreement states that a breach of loan covenant entitles bank to demand immediate repayment of the loan. Hill company and its subsidiaries do not have sufficient liquid assets to repay the loan in full. Hill has produced a business plan which forecasts significant improvement in its financial situation over the next 3 years as a result of launch of new products which are currently being developed. Now, what is it that we need to do? So let's talk about it, let's discuss about it. Basically, what you are going to do is that you are going to say that the deferred tax asset on unused tax losses shall be recognized to the extent that such losses are expected to be offset against the future taxable profits. So I repeat, the deferred tax asset on unused tax losses shall be recognized to the extent that such losses are expected to be offset against the future taxable profits. Now see, in the present situation, Hill company has been incurring losses for the past 2 years and has incurred a loss in the coming year also. Based on this, the deferred tax asset shall only be recognized if the management is able to demonstrate that it will have profits in future against which such losses can be offsetted, or else the deferred tax asset is required to be reversed. So that is one thing that you got to keep in mind. With respect to breach of loan covenant, in case if the negotiations with the banks have not been concluded as yet, a best estimate is to be made of the likely outcome of the negotiations, and the liability shall be presented as the current liability. Further, since there are insufficient liquid assets to settle the debts, therefore, in case if the bank demands immediate repayment, the entity may be required to surrender. The entity may be required to surrender its since there are insufficient liquid, the entity may surrender its asset and may have going concern implications, in which case the entity should prepare financial statements on a breakup basis. Now, I've actually gone at a very extreme case. But I've generally given you an idea that how these things are gonna be. So we are actually done with this question also, which was about part of consolidation, part of some other treatments from the financial instruments, and part of with respect to the classification of liabilities.